In today's video, we'll be talking about day trading in the tax-free savings account, which is a topic that's made headlines and somewhat worried everyday Canadian stock market investors over the past couple of years, with a more recent case surfacing once again with a TFSA investor on the hook for hundreds of thousands of dollars in owed taxes to the CRA, which he believed to be tax-free, of course. The worry here is that the CRA is starting to increasingly target people who they believe are using their TFSAs to conduct higher risk trading of investments that are not intended for the TFSA program to begin with, or people who are simply utilizing the tax-free savings account to day trade and not pay any tax. And if you're someone who, like myself, has and continues investing in a TFSA, well, it's important to understand what this could potentially mean for you and how you can avoid getting caught up in any potential issues with the CRA yourself in relation to the tax-free savings account. By the way, I wanted to mention that I decided to make this video after seeing another video on the topic over on fellow YouTuber Russell Matthews' channel. And since I've spoken quite a bit about the TFSA and what the potential consequences of day trading in the TFSA could even be in a couple of previous videos on my channel, well, I wanted to comment on this myself to share my thoughts and explain what happened here. As always, if you enjoyed today's video, make sure to drop a like. A like a day keeps the CRA away. Okay, let's get into it. So first and foremost, let's cover why the CRA is even targeting specific instances of TFSA investments in the first place, okay? And if this is the first time that you even hear about the TFSA, well, it's an acronym that stands for Tax-Free Savings Account, which is a popular tax-free registered Canadian investment account that essentially allows investors to earn a dividend income as well as interest on their investments tax-free over time as it grows. And if you want to learn more, by the way, about this account in particular and how you can utilize it yourself, make sure to check out my range of videos already posted on the channel about this very topic. But the thing is, at its core, the TFSA is designed to encourage Canadians to continuously save money and invest that money in a tax-efficient way over time. Because with the TFSA, investors are able to contribute a certain amount of their after-tax income to the account each and every calendar year, and the income earned on those contributions is tax-free as it grows. For instance, an investor who contributes $6,000 to their tax-free savings account this year could theoretically see the value of their investment grow and compound to a value of $20,000 in 10 years time, let's say, having accumulated dividends and other income along the way, all of which would then be eligible for a completely tax-free withdrawal. Now, this is in contrast to capital gains tax that is paid on the profits made from generally and typically selling an asset such as a stock or an ETF in a traditional investment account that is not registered, which accounts for tax paid only on 50% of the gain in question, but there is still tax to be paid. Now, additionally, the tax-free nature of TFSA investments means that investors can withdraw money from their account at any time without paying any taxes on the income earned. So overall, a TFSA is a great investment account option for Canadians who want to save more money and invest in a more tax-efficient manner. At least that's been the federal government's intention when implementing and maintaining the account over time. And in fact, if you've been a long-time viewer of my channel, you would know that the TFSA is pretty much always the first account that I would recommend when a new investor is looking to invest in the Canadian market. Now, in recent years, we've seen an increase though in cases where the CRA has been cracking down on investors who they believe are abusing though of this tax-free benefit and nature that the TFSA has to offer. And while you can invest in a variety of different assets within your TFSA, the CRA is focusing on people who are using their accounts for higher risk investments, such as, for example, day trading, options trading, and foreign exchange trading, forex trading, which they've deemed to be a business venture rather than a more longer term traditional style of investing. And really though, here's the thing, although the rules and regulations around investing in a TFSA, they definitely are somewhat of a gray area relating to the frequency and size of trades you're able to make in the account. Well, in general, you're not supposed to be day trading or treating your investments within a TFSA as a business, which, let's just be honest here, day trading most certainly is. It is an active form of income, and that could be deemed as business income. And traditionally, when you're buying stocks and other investments for the long term in a tax-free savings account, the difference here is that these are considered to be passive investments, which is what the TFSA was ultimately intended for at its core. Okay, now the larger issue for the handful of investors who have been targeted by the CRA is that when they've deemed that you've been day trading in the account and thus constituting it as a business venture, well, those gains are then considered to be business income, which is 100% taxable and not even subject to the capital gains exemption at 50% of those gains being added to your taxable income. That is a huge difference. And really this is significant because it means a, say, $100,000 gain would be added to your taxable income and potentially run you up the marginal tax rate brackets, bringing us to the situation at hand that I wanted to now cover. All right, so this is the article in question that I've been referring to. So the title is "The CRA is actively looking for people who day trade investments in their TFSA." And this was posted on February 16th of 2023. Scrolling down, we can see in the second paragraph essentially what this is all about. So a tax case decided earlier this month involved a taxpayer who grew his TFSA to more than $617,000 from $15,000 in only 3 years by day trading penny stocks. It goes on to say that the taxpayer opened his account at the very beginning of the program's launch in 2009. That would mean that they would have, a very large contribution room available, and it was a self-directed TFSA. All securities purchased and sold by the TFSA were qualified investments as stipulated by the Income Tax Act. So that's something that's also, interesting to bring up here, is that the CRA deems certain investments as eligible or non-eligible to be in the TFSA. Essentially, in this case, the individual was playing by the rules with qualified investments. It was just a gray area and wasn't necessarily playing within the confines or boundaries of what the CRA wanted in terms of how much he was, day trading or investing. Scrolling down, we can see here the taxpayer contributed the maximum allowable contributions of $5,000 to his TFSA, 2009, 10, and 11, and by 2011 his TFSA had grown to $617,000. So it's interesting that this is now coming up, several years later, almost actually, a decade later. These trades were done a decade ago, but it's only now that the CRA is cracking down on this case. By the end of 2012, the TFSA's market value had dropped back down to $560,000, and therefore he liquidated the entirety of his securities of nearly $550,000 on a tax-free basis to himself. So huge payday in this case. What is that, $530,000-ish in tax-free capital gains in this instance. We can see that the CRA had deemed at least a large portion of these trades as being for business purposes, and so the tax assessed was based on taxable income of $44,000 in 2009, $180,000 in 2010, $330K in 2011, and then $14,000 in 2012. That is a huge amount of taxable income for each of those years. And of course, the taxpayer is then obligated to pay back tax basically on these amounts. And then they go on to say that, the TFSA is generally exempt from having to pay tax on its income, subject to these two exceptions. TFSA holds non-qualified investments. That wasn't the case for this individual, or if they're carrying on as a business. If either exception applies, then tax is payable by the TFSA on its taxable income. I've read through all of the CRA's documentation about this. The truth is that it is very much a gray area, and what they do deem as being day trading activities is not clearly spelled out. So in this case, of course, if the guy is doing hundreds of transactions a month and you can see that they're within a couple of days or even within the day, sure, it is day trading. So, but for most individuals who are trading a couple times a month or even a couple of times a week, it's pretty gray as to where they would draw the line. And to be honest here, if you're not making a huge gain like this, they don't really care if you would be day trading. At least that's my view of things. If you're not really making a killing, even if you're day trading, are they really going to come after you for a couple $1,000s in gains? Debatable. Having now had the chance to look over the article, do I agree with the way that the CRA has treated certain investors here with the tax-free savings account, slamming them with six-figure tax bills? Ultimately, I think it's harsh, and everyone's going to have a different opinion here, but I definitely think this is a harsh way of treating things, especially considering the way that the CRA and government treat other aspects of their internal revenue and the way that they ultimately just manage money in the bigger picture. At the end of the day, most people are not going to be successfully day trading up to $600,000 from a $15,000 initial investment. That's just not going to happen based on the data for most people. So in my view, why penalize people or investors here who have been successful with their investments? This isn't impacting the market like, say, foreign buyers or speculators have in the real estate market. This is just a couple of people who have hit home run investments with their TFSA. At least that's how I see it. Of course, that's my way of viewing things. I'd love to know your views down below in the comments. Now, alternatively though, we have the government of Canada also giving out billions of dollars during the pandemic to basically anyone who was asking for a handout, right? The government had also a $600 million election in this exact same time frame. We've seen billions and billions of dollars burned through government inefficiencies and bureaucracy, but as always, targeting the individuals is something that they just seem to come back to. That just seems to be the way that it is here in Canada, and it's something that I have really just come to expect at this point. All right, rant over. Realistically, if you're watching this, chances are you won't be targeted by the CRA and you have absolutely nothing to worry about regarding your TFSA being treated as fully taxable business income, because realistically here, you'd know that you're somewhat playing with fire in this gray area and not following the intended rules, even though, truth be told, they are extremely ambiguous and the rules are not clearly set in stone, right? But in the bigger picture though, you would probably still be aware of the fact that, hey, I was day trading a lot and I, grew the value of my investments up, let's say 10x. Ultimately though, the CRA is just concerned that people are abusing of and using their TFSAs as a way to avoid paying taxes on income earned through a business essentially, which can lead to a significant amount of lost revenue for the government over time, which is why they're now cracking down on these types of activities in certain instances. And I think that by cracking down on people like we did just cover, they're really just trying to send a message that they are in control as always, and like a lot of what the Canadian government does like to do, keep people in line and weary of an audit. At the end of the day, you need to remind yourself of the fact that the TFSA is a registered investment account, meaning the CRA has records of every single transaction you've made within that account. And we all know that they can essentially choose to treat you however they want. I used to work at the Government of Canada in the department that dealt with the RESP, which is different of course, but it's also a registered investment account. And they have databases with every single transaction from every single one of your accounts and RESPs in general. So they're definitely able to reprimand you if they want. I'm fully aware of the fact though that this is a very polarizing subject where some people have strong opinions on each side of the coin, right? So I'd love to know what your thoughts are down below in the comments. Let me know what you think of this situation. And by the way, if you do want to learn more about stock market investing in general, highly encourage you to check out my full stock market investing course that you can find down below in the description over on Skillshare. It has over 7.5 hours of free content there that is extremely high quality. Finally, if you want to open up a stock market account to start investing yourself, check out Trade or Wealthsimple Trade, both linked down below in the description, and you can get some nice sign up bonuses there. So thanks a lot for watching, and I will see you in the next one.